what you talked about there was return on life versus return on investment.
This article comes to us from the Behavioral Investment blog.
Love it.
behavioralinvestment.com. And it is titled, Learning to be a Good Investor is Hard. You know, if learning to be a good investor is hard, I wonder how hard it is to be an excellent investor.
I mean, nearly impossible.
That's kind of the gist of this article, isn't it?
Well, he's focusing, you know, his blog focuses on behavioral finance. And you and I both love how much behavioral finance has risen kind of academically, and more investment advisors are aware of human psychology and how we make decisions. But sometimes I've even found this in my own life. Like, we'll read an article about, you know, a bias, and then getting to the point where I can communicate that to a client to help them make better decisions is hard. There's a difference between kind of the theory and then the practice. And so this blog is all about taking some of these behavioral concepts, learning that humans don't always make rational decisions when faced with challenges, and using this behavior gap to improve investment returns, I think is a worthwhile endeavor, and a great reason to have a blog and kind of learn from what he's putting out there.
All right. So why is it so hard? Why is it so hard to be a good investor? Comes back to feedback loops, right? It just, man, investments kind of provide pretty terrible feedback loops in general, especially from a high level when you look at the market. And you have to have an effective feedback loop in order to have good learning.
Yeah. So take, for example, somebody that invests $50,000 January 3rd of this year, right? And they put it in the S&P 500. Maybe they're down 29% year to date. That's immediate feedback. Well, I guess recency. They've got pretty immediate feedback. Investing, bad. Down, lost money, do something different, right? So, but in reality, if we look at that investment 10, 15 years down the road, it may have been a fantastic investment because it got them on track to do what they need to do in the future. But in the immediacy of the feedback, it's not going to be helpful in continuing to invest.
In the world of investing, those feedback loops are long, they're noisy, they're erratic. When you look at those three things, you look at this chart of, well, it takes a long time, right? So we have something that takes a long time in order to figure out if we made the right decision. It's not like you just put your hand on the stove, you got burnt, okay, bad decision, move on.
Not going to do that again.
Don't do that again, right? It could take years to determine if the investment you picked is actually going to be the right choice. And it's just unclear at the moment, right? Because you have all this noise too, because you have someone saying needs to be in value, needs to be in growth, you should be in small caps, should be in mid caps, you know, the asset is 60-40 is dead, right? You have all of these things coming at you. I think it's the noise that largely makes it unclear if you've made a good decision at this time. The neighbor says this, the neighbor says that. And then you have the impact, though. The impact of making a bad decision can be big, right? It can be catastrophic, especially for a retiree. You know, someone that's stepping into retirement, you know, I always think of, you know, one gentleman we met that got into trading equities. I think it was largely in the oil realm, and ended up having to go back to work, right? And then came in to visit with us to say, now what do I do? I've lost all this money. Well, you have to go back to work, right? There was little that could be done. It was almost catastrophic, right? I mean, it was borderline. It could be arguably catastrophic. You know, and I think those are three things to understand, that we need to have a long-term outlook. Okay, we need to. It's going to take a long time. We need to have a long-term outlook, and it's unclear, right? You won't know if it's successful, you know, today. So in order to protect yourself against that clarity, this is why we diversify, right? And then I think what's often misunderstood is just how catastrophic the wrong decision can be. You know, we and that's a lot of behavioral finance that comes into play there, right? We get a little overconfident in the decisions we're making, especially if we make a few good ones in a bull market. And we need to understand the gravity of the situation. And that's often what we're helping individuals do in our office, is understand the gravity of the situation. And this makes me think of some individuals we met that are, say, 5 years out from retirement. They're 5 years out from retirement, and they say, well, I can afford to continue to take risk with my portfolio. And we show them, okay, if you continue to take risk with your portfolio, you'll be fine if the market continues to perform well. They say, okay, well, that sounds good. But if the market is a disaster, you don't get to retire. And if it flatlines, you don't get to retire. You have to make a minimal return in order to retire 5 years from now. But it may only be 2 or 3%. Otherwise, you don't hit your target, and you're going to work past that retirement date. That's fairly major, right? And then an analogy my dad would often use that I heard years and years, it was, well, you've got $1 million today, and with the risk you're taking, then 12 months from now, that million could be 1.1. How's that change your life? Doesn't really change my life. Well, with the risk you're taking, 12 months from now, that million could be $500,000. How's that change your life? Dramatically changes my life, right? We have to understand the consequences.
Yeah, understanding the consequences, but I think what you talked about there was return on life versus return on investment. And too often we get far too caught up in the short-term return on investment. It's more like a scoreboard. Casey, you talk about this a lot. Some people look at their 401k balance or their IRA balances like a scorecard, and that can lead you to making decisions that are not going to be wise long term.
It can become a game. It can become an addictive game, much like gambling, right? We look at that scorecard. It's just numbers on a sheet of paper. It's just numbers on a computer. And then if I put money here, we can so quickly make disastrous decisions with our life savings that previous generations couldn't, because there was a pension fund manager that was managing their pension that knew the magnitude of the decisions they were making, and they were held directly liable for those decisions, legally liable for maybe thousands of individuals that were depending on that pension fund to last into perpetuity. But then you go, wow, it's just me, and you don't have that same degree of understanding around the risks sometimes as some generations past pension fund managers did.
Well, and I think another point that you made there, which is pretty clear, is sometimes we don't focus on investing as much when we're younger. We're just plugging away into the 401ks. We're saving. We're trying to build. We're trying to accumulate. And that gentleman that you talked about that started trading stocks, he never traded stocks when he was in his 20s, 30s, 40s, 50s. He was doing seemingly everything right to get to that point where
doing really boring stuff.
Yeah, doing really boring stuff. And he got to where he needed to be and then made critical decisions at the absolute worst possible time, which then ruined 20 or 30 good years of good decisions.
Yeah, and so there's three things here. And when it comes to having a good feedback loop, there's kind of three pillars of that. That is response, number 2, results, number 3, impact. So when it comes to the response time, that's really the time. How long does it take to figure out what's going on? And it's easier to learn when we have a short feedback loop, when we have a quick response time. We put our hand on the stove, we know exactly what's happening, right? It's harder to learn when it takes a long time. If it takes you 2 years to feel the burn from touching the stove, not very helpful. You might have a really painful 2 years following that 2 years, right? Because you continue to do it time and time again, not understanding what was actually going on. And then you have results. And I think of results as, what's the outcome? What's the outcome? What's actually going to happen if I do X, Y, and Z?
In when it's easier learning, that's a clear outcome. When it's harder learning, it's an unclear outcome, like a lot of the decisions we're having to face with retirement planning.
Yeah, we need to know what that outcome is, and we want to know what it is clearly. And if it should be pretty clear, we're going to touch a stove, we're going to get burnt, right? It's pretty clear what the results of that are going to be, what the outcome of that is going to be. As you said, investing is a little bit different. Then we have impact. I like to think of impact as the magnitude. This is the magnitude of the impact, the magnitude of what's actually going to happen at the end of the day. It's easier to learn if that's minor, right? If it's a minor impact, okay, great, I can make a quick adjustment. And this is why I think this is just one of the best reasons for diversification, right? I know I keep saying that. It's so boring. It's so old. Everybody says it. We need to diversify, but that's really important. If you'd like to take the information that you've gleaned here to the next level, all you have to do is this. Click the link in the description and schedule a 15-minute phone consultation with an advisor on our team where you can get answers to your own unique questions and concerns. If you put this in the framing of falling off a cliff, you fall off a cliff, magnitude is so large, the impact is so large that you don't get to learn from that mistake, right? You don't have the luxury of learning from mistakes that are too large in magnitude. So as you're investing, you want to make sure you minimize the impact of the decisions that you're making and try to find as much clarity in those decisions as possible and shorten the feedback loop as much as you can as well.
Right. So we talk about how do investors learn? So how do we go about doing this? And I think something he mentioned here is learn from our own experiences, but also from the experiences of others. He says our own personal sample size is simply too small. And I think that is a great, great point. That's where getting good counsel, that's where getting a framework around your decision-making process where you can help take the burden off of you by learning from others as well.
Yeah, and I think where we have to be cautious with this, understand that our own experience is very small in a biased sample. I think that also relates to other people's experiences that we take as, oh, that's the way it was for them. That's the way it is as a whole. Grandma had a life insurance policy that never paid out. Therefore, life insurance bad, right? And
Sure.
No, Grandma had a terrible life insurance policy. It was actually an accidental death benefit policy that she got for free at the bank, right? So let's understand what we're actually... Let's be very careful taking other people's experiences or our experiences and making that the truth for all experiences, because that's not always the case. Number two is ignoring near-term feedback as much as possible. And I
Love it.
It's hard, though. That's hard.
Oh, yeah. It's hard for everybody.
How you going to do that?
I mean,
Especially, take a year like 2020. Take a year like this year, right?
Yeah.
What if you just started investing this year? I mean, I've got a friend that basically just started investing this year for the most part, and you're going, yeah, I'm not doing that again, right?
Sure. I buy stocks that go down. I buy gold, it goes down. I buy Bitcoin, it goes down, right?
Yeah.
You have to try and minimize the noise, right? You got to
People have been around a long time, investing for a long time. They don't have that kind of issue, right? Because they didn't have. They've been through it. They've seen the long term of this. They know to ignore some of that near term feedback. But at the same time, I think it's important not to just entirely ignore it. That's where you can get yourself in a lot of trouble. So you might go make an investment. It doesn't have to be in the stock market. You could go invest in a small business and just ignore it. Right? I'm just going to let it ride. Well, they haven't made any money for 6 months. It'll be okay, right? We need to set some reasonable expectations of what the short-term results should be. And I think we use a great tool to help people do that, a tool called Riskalyze, which has really been revolutionary for the financial advisory world. And that's a tool that's going to share with you over the next 6 months, 95% probability your returns land in this range. Right.
You can see kind of with some high probability, this is probably where my return is going to be. Here's my upside. Here's my max drawdown downside. Am I okay with those results, good or bad?
And I think if it's if it's out of that range, you should be concerned, whether it's to the upside or the downside, right? If you find yourself 6 months from now, well, the range was supposed to be, up 20, down 15, and now I'm up 50%. You go, that's a red flag, right? I need to pay attention to that feedback that I just received. And next, learn from the right people.
Learn from the right people. I think that's so helpful, right? Identifying who you share beliefs with or values with, value systems. I mean, there's certain blogs that I go to every week when I'm looking at curating content. There's certain resources that I use every week because I've learned to trust those individuals. I've learned to find individuals who can be mentors. I've learned to find resources that I can really trust the feedback from.
We want them to have three things. We want them to have similar interest, similar objectives, and plenty of experience, right? And when I think about this, I did a wealth summit for a group. It was myself and another speaker, and we couldn't be more different, right? Two very different people in our interests and our objectives and in our experiences as well, right? Two completely different experiences. I looked at that individual and I saw someone that was interested in no longer working, right? 100% of the time was going to be spent surfing and spending time with family. And that's great. I want to do those things, but I love my work, and I don't have interest in just, surfing all. I don't even like surfing, right? I mean, there's, I want to make sure somebody has similar interest to me. I'm not going to invest like this person invests. Our objectives weren't the same. This person wanted to quit and retire and enjoy life and develop all this passive income. I go, that's just not for me. Generating a bunch of passive income for me is a tax nightmare, and that's not what I should be doing with my life savings. Now, I've got one of my closest mentors. We talk every week, and this is someone that's trying to build a business that can have a monumental impact in the world and build his own financial independence on the side. He's got his financial independence, and now he's trying to build something that can be around for the next 100 years, that can have an outsized impact on the world. And I go, that's someone that I want to follow. What are you doing with your life savings? How are you managing your dollars? This is someone that's been incredibly successful and has been doing it for a long time, plenty of experience. So find someone with the right interests, objectives, and experiences before you start following those individuals.
Right, before you start acting upon advice that you're given. Lastly here, Casey, what I would touch on is focus on general principles rather than specific stories. I think where he's going here is trying to understand that if you're focusing on a trading system, or if you got a chartist newsletter, the amount of time that you're spending may be kind of a wasted time. Focus on those general principles. Get a framework.
And dangerous.
We talk about having that framework for making decisions is going to remove some of this. So focus on these general principles. Build yourself a framework and an easy way to try and make educated decisions.
I mean, look at some of the best investors in the world, the best investment managers, I should say, right? They're best investment managers. They have a very narrow area of focus. They're small cap managers. They're value managers, right? But they don't invest their life savings in just that one narrow area.
Right.
Those are two different things. There's investment management, and then there's your own personal financial life. Those are two very different things. And I'm going to add one more in there. That is weigh evidence correctly. Filter evidence that's robust, that is broad, long time horizon, sound principles, from that which is flimsy, narrow, transitory, biased. And when I think of that, that brings me to two different individuals that come to mind. You've got Dr. Wade Pfau. Here's someone that is broad, focus on long time horizons, sound principles, covers a lot of different topics when it comes to creating a retirement income strategy, and shows up very unbiased, doesn't say that there's one way to do things. The other one is there's one named Fisher out there, and Fisher is very narrowly focused, right? Focusing on one type of investing. This is what we do, right? This is all we do, and very biased, trying to sell something, where we've got Pfau who's trying to teach, right? And we've got another one that's trying to sell something. I think we've got to be careful at the end of the day. I think that is, where are you getting your information, right? Did you really check your sources and know where they're coming from and why they might be coming from that area? And we'll wrap up with this. Base your decisions on sound principles. Always be willing to learn, and understand that most short-term feedback can happily be ignored.